Welcome back to the Deep Dive, the only place where we take a mountain of complex financial data and, well, transform it into the crucial, need-to-know insights you can actually use.
That's right.
Today, we are strapping in for an intense look at a company that is going through a radical and, frankly, audacious transformation. We're talking about BitMine Immersion Technologies, ticker BMNR.
And I think it's fair to say this isn't just a routine earnings review. This case study is, it's pure corporate alchemy. It's a fascinating exercise in strategic redefinition that has implications far beyond just the crypto sector.
Alchemy is a good word for it.
We're looking at a fundamental change in how a publicly traded company can even generate value.
Okay, so our mission today is laser-focused. We are analyzing the BMNR fiscal year 2025 earnings report. And we're going to use a very structured 5-part framework, the 5 slides, to move way beyond the initial headline numbers.
Right. We need to grasp the true, radical strategic pivot that management has undertaken here.
And the need for this deep dive, it really starts with this central, massive contradiction you see right on page 1.
It really does. The operational revenues are tiny, about $6.1 million, which is pretty typical of a small-cap industrial firm.
Sure, nothing to see there.
But then somehow the net income and the earnings per share, the EPS, have just exploded to levels you'd normally reserve for, like multi-billion-dollar S&P 500 titans.
Which just doesn't compute.
At first glance, it really defies traditional financial gravity.
It seems impossible. How does a company with $6 million in sales report over $328 million in profit? That's not business. That is a financial magic trick.
Well, it's not magic. It's strategy. A highly concentrated, highly aggressive strategy, and a very precise application of accounting rules.
Okay.
Our core thesis statement, the one we have to carry through this entire deep dive, is that this extreme bifurcation is the intended result of management's alchemy of 5% strategy.
The alchemy of 5%.
Yep. They are prioritizing the accumulation of Ethereum, or ETH, over traditional mining optimization. For BMNR, the balance sheet, specifically the value of their crypto treasury, is now the primary engine of value.
So the income statement is what?
It's mostly just noise. It's driven by market volatility, not by making and selling things.
So you are telling us to look past the heat of the mining rigs and go straight into the vault. This is a story about asset holding, not operations.
Precisely. The mining operation is now just a footnote to a massive investment fund.
Okay, let's unpack this with our first segment. We have to tackle the initial data points that caused all this market confusion.
Let's do it. Now for slide 1, the at-a-glance scorecard.
All right, so this first slide, it basically gives us the strategic executive summary. And what we see is a company that has explicitly changed its identity. The sources describe this as an irreversible strategic pivot from a traditional industrial cryptocurrency mining operation to a large-scale passive treasury management vehicle.
And that phrase, passive treasury management vehicle, that's the key. That unlocks the entire report.
How so?
It signals that all the traditional valuation methods you might use, things focused on operations like price-to-sales ratios or high gross margin analysis, they're now secondary.
So throw out the old playbook.
You have to.
Yeah.
What matters now is the book value per share and the mandated fair value accounting of their digital assets. The corporate goal is no longer to mine cryptocurrency efficiently. The goal is to hoard and accumulate the underlying asset efficiently.
Okay, let's get into the hard numbers from the internal data. Total revenue for fiscal year 2025 was $6.095 million.
Right.
And that is an 84.14% increase from the prior year's $3.310 million.
So an 84% year-over-year increase is, on its face, statistically robust. It's excellent.
Looks great on a chart.
It does. However, you have to immediately put it into context. The absolute figure, just over $6 million, is minuscule when you measure it against the company's multi-billion-dollar market cap.
So it's a drop in the ocean.
It confirms that the legacy revenue is just not the primary valuation driver. That 84% growth is, frankly, peripheral noise in the context of their larger asset base.
Okay, now for the figure that broke the headlines, the net income explosion. They reported net income applicable to common shareholders of $328.16 million.
An incredible number.
It's a massive reversal from the prior year's $3.293 million loss. That's a positive delta of over $331 million.
And this massive swing to profit, this is the direct result of the specific accounting rules they follow. This income explosion is almost entirely attributable to the required accounting recognition of unrealized gains on their digital asset holdings.
Okay, let's drill down on that. That's a necessary accounting detail. Why is this gain unrealized, but it's still reported as income?
This is the core of the financial alchemy. BMNR has transitioned its reporting to adopt the fair value accounting method for its massive Ethereum treasury.
Okay, fair value.
Under this GAAP method, if the market price of the Ethereum they hold appreciates, meaning it just increases on paper, they are required to recognize that increase, that mark-to-market gain, immediately on their income statement.
So the reported figure, that $328 million, it includes an $805 million gain on those digital assets.
Exactly. It's an appreciation gain. It's non-cash, but the rule mandates it be reported as income, and that's what inflates net income so dramatically.
So just to be crystal clear for everyone listening, it's not cash they earned by selling anything. It is literally just the rising paper value of the assets they own.
That is exactly it.
And that then feeds directly into the earnings per share figure.
Correct. Diluted EPS came in at $13.39, reversing a painful loss of $1.32 the year before.
And we should probably quickly note the difference between the basic EPS of $13.60 and the diluted EPS of $13.39.
We should. We always rely on the diluted figure because it factors in all possible future shares from warrants, options, convertible debt, you name it. It gives you the most conservative, truest picture of your stake after all the potential slices of the pie are handed out.
Right. And the small 21-cent gap between basic and diluted suggests that the potential dilution burden isn't excessively heavy at current market prices.
No, it's a manageable dynamic.
Which is good to see.
It is. But what's truly fascinating is how this internal data just clashed with external market expectations.
Okay, how so?
Well, on the revenue side, BMNR missed the Zacks consensus estimate of $6.8 million by over 10%.
A double-digit revenue miss for a standard industrial company. I mean, that would usually send the stock plummeting.
Absolutely.
Yet BMNR stock rose in the pre-market. Why did the market just ignore that revenue miss?
Because the miss reflected operational noise. It was likely caused by volatility factors that are just inherent to the legacy mining business. Increased mining difficulty, higher energy costs, maybe energy curtailment.
Things that don't matter to the new thesis.
Exactly. Since the core investment thesis is now asset accumulation, that operational volatility is peripheral. It just doesn't matter that much to the new class of investor buying this stock.
So conversely, the EPS result was what the report calls a massive beat.
A massive beat is an understatement. Analysts were modeling a significant loss, approximately $2.89 per share, but BMNR reported a profit of $13.39.
The variance is staggering. That's a beat of over 500% relative to loss expectations.
It is. And this reveals a fundamental modeling failure by Wall Street. The analysts, they focused on the core operating income, which, as we'll see soon, is still loss-making.
So they were modeling the old company.
They failed to fully account for the GAAP requirement to report the appreciation of this vast crypto treasury as net income. They modeled the miner, but the company reported as a closed-end asset fund.
So if analysts miss the EPS beat by 500%, what signal does that send to you, the listener, about the quality of the traditional research you might be consuming on a name like this?
It signals that you must discard the traditional framework for this specific entity. You cannot use a standard PE ratio when the E, the earnings, is driven by non-cash volatile appreciation.
The market got it, though.
The market, which is often smarter than the aggregate analyst consensus, prioritized that massive EPS beat and the strategic dividend announcement. That's why the stock rose 4.18% pre-market.
Okay, here's where it gets really, really interesting for me, connecting this all back to the share count. Diluted shares outstanding went from 2.49 million to 24.52 million. That is a massive 884% increase.
A nearly tenfold dilution of the shareholder base.
That kind of dilution normally crushes EPS. I don't care how good your operational earnings are.
It could be the best in the world.
The fact that the EPS still skyrocketed from a loss of $1.32 to a profit of $13.39, despite a nearly tenfold increase in the share count, that feels like the single most important lesson from this slide.
It absolutely is.
This is accretive dilution, a term that I think needs a deeper explanation.
It's a textbook definition of it. Accretive dilution occurs when the new capital raised by issuing all those additional shares, the 22 million new shares in this case, is deployed into an asset that appreciates faster then the share count expands.
So walk us through that.
BMNR raised capital. They used it to buy Ethereum. And the appreciation of that Ethereum treasury, that $805 million gain, it vastly outpaced the dilutive effect of adding those shares.
So issuing new stock actually increased the value per share.
That's it. Management essentially used the stock market as a liquidity generator, poured that cash into the crypto market, and the returns from the crypto market retroactively justified the enormous stock issuance.
But I have to ask, what's the danger if the asset stops appreciating or goes down?
Well, there's the high-risk part. The strategy is inherently risky. If the price of Ethereum reverses and crashes, that entire mechanism works in reverse instantly.
So the dilution remains.
The massive dilution remains, but the asset appreciation disappears, leading to a catastrophic destruction of book value per share. The entire strategy is a leveraged, high-stakes bet on asset appreciation.
Fascinating stuff. Okay, now that we understand the power of the balance sheet, let's delve into the mechanics of the profitability, or maybe the lack thereof, in the core business.
Right. Let's do it. Moving to slide 2, the engine of profitability.
This section is where we really separate the accounting construct of profitability from the harsh reality of operational efficiency. For the learner, you have to remember that profitability for BMNR is an accounting function first and an operational function a distant second.
This is a perfect way to frame it. Let's start with the gross margin analysis. This measures the efficiency of the core industrial operations, the mining and leasing, before any corporate overheads are applied.
So we're basically asking, is the basic act of their legacy business profitable at all?
Exactly.
We use the internal data. Total revenue was $6.095 million, and the total cost of sales was $5.785 million. So that leaves a gross profit of only $310,000.
And when you run the calculation on that, it results in an exceedingly thin gross margin of just 5.09%.
5%.
And to put that into some severe context, a 5% margin suggests that for every dollar they earn, 95 cents is immediately eaten up by direct costs, electricity, direct labor, equipment depreciation.
That is an industrial segment that is barely covering its variable costs. I mean, efficient miners, they usually hit 30, maybe 40% margins, even in average market conditions.
They do.
This 5% figure confirms that the core industrial operation is just sputtering. It's structurally disadvantaged.
And this finding alone, it supports the thesis that the strategic pivot was absolutely necessary. The legacy business was simply too inefficient to carry the weight of a multi-billion-dollar valuation.
Okay, now let's look at the part of the income statement that is, numerically absurd. The operating margin.
Yes.
When we move down the sheet, we hit the operating expenses, and this is where that gap rule really kicks in.
It does. We see general and administrative expenses of nearly $14 million, but then you see that $805.008 million unrealized gain from digital assets reported as a negative expense.
A negative expense, so it mathematically inflates the operating income.
It does. And when you calculate the GAAP operating margin, including that $805 million non-cash gain, the result is approximately 7,288%.
7,288%.
That number is, it's completely useless for comparative analysis. But it's a beautiful demonstration of the absurdity inherent in the accounting rules for these types of assets.
So it serves a purpose.
It serves a crucial purpose.
Yeah.
It highlights instantly that the operation being measured under GAAP is the holding of Ethereum, not the mining of it. You have to ignore this number if you want to gauge management's industrial skill.
Okay, so let's do that. Let's perform the necessary core operations adjustment. We'll strip out the non-cash noise, the $805 million crypto gain, and the $349 million warrant expense to see what the management team actually accomplished in the industrial business.
Right. We take that $310,000 in gross profit, and we subtract the core fixed expenses, which are the general and administrative, or G&A, costs of $13.984 million.
And the result is a core operating loss of negative $13.67 million.
This is the definitive conclusion on their operational health. The industrial operations, the actual day-to-day running of the business, lose approximately $13.7 million a year.
Wow.
Every single shareholder is entirely dependent on that $805 million gain in crypto assets to subsidize this significant annual operational burn.
So it's a massive structural hole that the asset appreciation has to fill. It's an investment fund that happens to lose $14 million a year running a struggling data center business on the side.
That's a perfect summary. And we quickly examine the return on assets, or ROA. We see another interesting contrast. The net income was huge, $328 million.
Right.
But the total assets are nearly $8.8 billion.
So the resulting ROA is only 3.73%. Why is a massive profit resulting in such a modest return?
Because the sheer size of the $8.8 billion asset base acts as a huge divisor. The appreciation was massive in absolute terms, but relative to the scale BMNR has built, it was actually a pretty modest return in that specific reporting window.
So what does that mean going forward?
It reinforces that management have to secure massive appreciation or introduce a yield mechanism to move the stock price meaningfully from here. They've gotten too big.
And that $13.7 million loss in the core business, it makes the shift to a treasury manager look like an existential imperative.
It really was.
Let's dig deeper into the actual pieces of that industrial operation that are bleeding cash.
Now we discuss slide 3, the engine room business segment performance.
Okay, so BMNR provided a highly granular report, which is great. It details 5 revenue streams, and that allows us to determine precisely which parts of the original engine are still running and which are well broken.
Right, and let's start by looking at the segments that were historically the core of the business.
We'll start with what the report calls the broken legacy, self-mining. The revenue here was $3.133 million, but the costs were $3.277 million.
And this is the critical existential finding. A negative gross margin of negative 4.6%.
Negative 4.6.
To translate that, it costs BitMine $1.05 to mine $1 worth of crypto. The act of mining itself is economically destructive. It confirms the operational business model is just structurally unsound.
And when you connect this back to that $13.7 million core operating loss we just calculated, you see exactly where a large portion of the cash is flowing out.
You do.
This confirms that the pivot away from operations isn't merely opportunistic. It was an existential necessity, probably driven by things like fixed power contracts and rising difficulty rates.
And it also means they are paying a premium just to acquire crypto, which, it brings up a specialized technical reason why they might tolerate this kind of loss.
Oh, that's interesting. What's that?
The acquisition of what are called KYC-free coins.
Okay, let's elaborate on that highly technical point. What is the non-economic benefit of a KYC-free coin?
So KYC stands for Know Your Customer. When you buy crypto on an exchange, the source of that capital is traceable. However, when a miner generates coins directly from the network, those coins are often viewed as having superior provenance.
They're clean.
They're KYC-free because they originate from the network's consensus mechanism, not from a traceable financial institution. Now, while this is maybe less critical for a massive public company, for a large holder, the unique source of a mined coin can sometimes provide a non-economic benefit that management deems worth subsidizing.
Though a negative 4.6% margin is a very high subsidy.
It's a very steep price to pay.
Okay, moving to the second segment, leasing. This is where we see management attempting to salvage some value from their physical infrastructure. Revenue was $1.881 million, and that resulted in a positive profit of $132,000.
The emergence of this leasing revenue, which was non-existent before, is highly telling. Management is actively de-risking here.
How so?
They're leasing their infrastructure for a fixed fee, which avoids the volatility and the difficulty risk of self-mining. The margin is low, only 7%, but it is crucially positive. They're converting a high-risk asset into a stable, low-yield fixed income stream.
Smart. Then we have the high-margin, low-scale parts, hosting and consulting. The combined revenue is only about $280,000.
Oh, peanuts.
But the margins are incredible, 83.8% and 85.4%.
And these segments are proof points. They show that management can execute high-margin services, but they are just far too small to meaningfully impact the multi-billion-dollar valuation. They are, at this point, negligible contributions.
Okay, and finally, mining equipment sales, which brought in $846,000 in revenue.
This is non-recurring revenue. It's likely representing the liquidation of older hardware as they upgrade their infrastructure, or maybe just raise a small amount of operating cash to plug that $13.7 million operational hole.
So the strategic summary of the engine room is pretty conclusive. The company cannot profitably operate its core industrial business.
Not at all.
The segment data entirely validates the decision to transition into an asset appreciation strategy that relies solely on the balance sheet.
The structure is crystal clear now. Bad at operating, but highly exposed to holding. So now let's look at the financial fortress they're holding their assets within.
Let's do it. Now we look at the financial architecture. Moving to slide 4. Financial strength and shareholder rewards.
And the balance sheet. This is the most vital component of this entire analysis. Total assets are massive. $8.795 billion.
Almost $9 billion.
And the composition of those assets is the investment thesis. 8.281 billion of that is digital assets.
The concentration risk is just staggering, but it's intentional. 94.2%, nearly 95% of the company's entire value is directly tied to the market price of its crypto holdings.
So buying BMNR stock is essentially buying a leveraged, high-beta, concentrated proxy for the Ethereum price.
No two ways about it.
But the other critical piece of the asset side is the cash war chest. They reported cash and cash equivalents of $512 million.
This cash position is extremely robust. If we connect this back to the core operational burn rate of approximately $14 million per year in G&A expenses, we can actually calculate the runway.
We can. 512 million divided by 14 million gives them approximately 36 years of cash runway at the current operational loss rate.
36 years. That is a profound finding. It effectively neutralizes all near-term bankruptcy risk, regardless of how poorly the self-mining operation performs. They have insulated themselves from the failure of their legacy business.
It creates a tremendous moat. But here is the challenge with that. This runway is only stable if the cash stays liquid.
Meaning?
If 95% of the assets are crypto and we enter a deep, prolonged crypto winter, management might be forced to liquidate some of that crypto treasury just to maintain operations and keep the cash account flush.
And that turns the 36-year runway into something much shorter.
Exactly. They're insulated from operational failure, but they are entirely vulnerable to asset market failure.
Okay, let's look at the flip side of that, the liability profile. Total liabilities are only $102 million.
This is a near pristine liability profile. The debt-to-equity ratio is negligible, 0.01. They're virtually debt-free.
But you're saying there's a nuance here.
The key nuance is the composition of the liabilities. 92 million of that 102 million is deferred tax liability.
So most of the liability isn't actually debt with interest payments, it's taxes they might owe in the future on profits they haven't even realized yet.
And that is what we call a good liability. It's taxes owed on the unrealized appreciation of the Ethereum they are holding. If the market reverses and the assets go down, the liability disappears. If it rallies, the assets easily cover it.
And no interest payments.
The absence of interest-bearing debt provides a crucial structural advantage, especially in this high-interest rate environment.
Okay, so this debt-free structure and massive cash runway, this paved the way for what might be the most sophisticated announcement in the entire report, the strategic dividend.
Oh, yes.
They declared an annual dividend of 1 cent per share.
This announcement is pure market structure engineering. At a current share price of around $30, a 1-cent dividend yields about 0.03%. It is economically meaningless for a retail investor who's looking for income.
So if the yield is irrelevant, what is the strategic value of that single penny?
It is all about checking the box for institutional compliance. Many large funds, pension funds, certain equity income mandates, large passive ETFs, they have strict internal mandates that legally prohibit them from buying non-dividend paying stocks.
I see.
By paying even a nominal 1 cent, BMNR legally checks that box. They open the door to potentially trillions of dollars in passive institutional capital that was previously locked out from buying their stock.
So it's not a reward for the retail investor. It's a strategic move to court institutional liquidity and signal stability.
Exactly. And it signals management's supreme confidence in the firm's long-term solvency. A company that's worried about cash alert would never voluntarily distribute cash, however small the amount.
It says, we are stable enough to survive, and we are now moving into the institutional asset class.
That's the signal.
That brings us perfectly to the future. What is management saying they're going to do next with this giant vault of assets?
Right. Finally, slide 5. The road ahead management's outlook and key takeaways.
The strategic narrative from Chairman Tom Lee, it seems to focus on 2 main pillars: continued accumulation and the activation of yield.
It does.
Let's start with that accumulation target, which they call the alchemy of 5%.
Management has explicitly stated their long-term goal of acquiring 5% of all circulating Ethereum, which given the current supply of about 120 million ETH, translates to a target of holding 6 million ETH.
And the press release notes they are already the largest ETH treasury in the world. They're holding an estimated 2.5 to 3 million ETH, valued at $8.2 billion.
So they are roughly halfway to their goal. And the critical implication of this for the market is that BMNR will continue to be a relentless, continuous buyer of Ethereum in the open market.
So they become a market force themselves.
They act as a perpetual high-volume support bid for the Ethereum price, absorbing supply as they continue to execute capital raises or convert other assets.
Mr. Lee also provided some explicit market guidance. He stated they expect crypto prices to stage V-shaped recoveries after drawdowns, and they are positioned accordingly.
This is a very aggressive bet on market structure. Management is not hedging against a prolonged slump. If a prolonged crypto winter or a global recession occurs, this aggressive, concentrated positioning could result in rapid and significant book value drawdowns.
So this is not a balanced, diversified approach.
No, it's a high-conviction, high-risk bet.
But the real game changer, the single biggest catalyst that everyone's watching, is the yield engine, Mavan.
Yes. Mavan, the Made in America Validator Network, is scheduled for launch in Q1 2026. This is the crucial step. This is what bridges the gap between being a passive accumulator and a cash flow generator.
So that $8.3 billion in Ethereum treasury right now is just sitting idle, waiting for appreciation.
Correct. Mavan will allow BMNR to stake this enormous ETH treasury.
And staking is essentially locking up the asset to help secure the network in exchange for rewards, which typically yield about 3 to 5% annually in new ETH.
Right. And if we run the calculation using a conservative 4% annual yield on their current $8.3 billion treasury, that translates to approximately $332 million in annual revenue.
$332 million per year, generated at virtually a 100% margin. That would entirely eclipse the $6 million legacy mining revenue, solving all the core operational profitability issues we identified earlier and transforming the company into a cash flow machine.
Successful execution of Mavan is the single most important fundamental driver for this company for the next 12 months. It converts their massive asset base into an active, high-margin revenue stream.
That brings us perfectly to the synthesis of the key takeaways for you, the listener.
First, and most importantly, the thesis drift is complete. BMNR is an ETH holding company that happens to operate a small, loss-making mining operation as a footnote. Your investment is a bet on Ethereum, not industrial efficiency.
Second takeaway, the balance sheet is the moat. That $512 million in cash, it provides decades of runway. It neutralizes short-term bankruptcy risk and gives them unlimited time to execute the Maven pivot.
Third, you have to track the Maven catalyst. This is the project that monetizes the entire treasury. If they execute this successfully, the stock should trade at a significant premium to its net asset value.
And finally, and maybe this is the most practical advice, we need to address the accounting noise.
Yes.
Retail investors must learn to ignore the volatile headline net income and EPS numbers. They're non-cash driven. Instead, the true metrics to track are book value per share and the growth in ETH holdings per share. That is the real health of this company.
The fiscal year 2025 report is a portrait of a company that has intentionally engineered itself to be a leveraged high-beta option on Ethereum. It offers institutional liquidity and potential staking yield, all while insulating itself from the failure of its legacy business.
So the ultimate question for the investor is whether they can successfully transition from being an asset accumulator to an asset monetizer via Maven.
That is the multi-billion-dollar question.
A truly fascinating high-stakes bet that we will certainly be tracking closely. This deep dive has completely redefined what BMNR is and why the market reacted with such contradictory behavior.
Understanding these 5 slides helps you see the deliberate strategy, not just a bunch of random volatile numbers.
We must conclude with our mandatory disclaimers.
Financial disclaimer. This report is for informational purposes only and does not constitute financial, investment, legal, or tax advice.
Yep.
The information contained herein is not a recommendation or solicitation to buy, sell, or hold any securities. All investment decisions should be made based on your own research and in consultation with a qualified financial professional. While efforts have been made to ensure the accuracy of the information, no guarantee is provided.
AI disclaimer. This report was generated by an artificial intelligence model. It integrates data directly from the company's official earnings press release with publicly available market data obtained via real-time web searches. Although the AI is designed to adhere to strict data sourcing and verification protocols, errors or omissions may still occur. All information, including financial data and calculations, should be independently verified by you before making any decisions.
Like and subscribe to StockAnalytics.ai YouTube channel. Members get access to our library of S&P 500 stocks and NASDAQ 100 library we are building out, and also get priority requests for company deep dives.